New this morning, Piper Jaffray's Michael Olsen out with a note making the case for Amazon stock to reach $3,000 in the next 2 to 3 years. That would be an increase of more than 60% from today's levels. Joining us right now on the Squawk Newsline, Michael Olsen, who is senior analyst at Piper Jaffray. Michael, thank you for being with us this morning. What gets you to this conclusion?
Yeah, what we're really doing here is making a valuation argument that if you split Amazon up into three major segments, which would be the core retail segment, AWS, and advertising, and then apply something close to a comp group average multiple to 2022 estimates for each of those segments, then you arrive at a share price of about $3,000 in about 2 years, or in mid-2021, when investors will begin to start trading the stock off of 2022 estimates.
What are the risks, though? I mean, there are so many things that are swirling with Amazon right now, with the idea of regulators potentially getting involved with a lot of the big technology names, with the idea of just the president not particularly caring for the founder, Jeff Bezos. How do you kind of factor in any of those risks, or do you?
We do factor in the risks by using relatively conservative growth rates, as well as what we believe to be conservative multiples. And in particular, Amazon's core retail segment is growing more than 4 times faster than the brick and mortar comparative companies. Interestingly, though, if we use a slow growth brick and mortar comp group multiple on Amazon's core retail business, it suggests upside from where the stock currently is. So in other words, investors are currently valuing Amazon's retail segment below a brick and mortar multiple, even though it's growing so much faster than that brick and mortar comp group. So that's just one example of how we believe there's conservatism in our analysis, and that bakes in some of the concerns that people may have.
You talk about the potential for a spinoff of Amazon Web Services. How likely do you think that is?
It's really hard to say, and we honestly don't have a good read on whether or not that could happen or not. But I guess I would just say that there's really no reason that those two businesses need to be combined with one another. That could appease some of the regulator concern, and ultimately it would be a good thing in this case, because it would sort of unlock the realization of value for each segment.
What happens if there's an economic slowdown, some sort of a recession in the United States between here and then? Would that impact Amazon, or because it's in the online sales portion of things, you think it's immune to anything like that?
I don't think it's immune. It would definitely have an impact, and that's probably outside of regulatory or other risks. That's probably the biggest concern, is some sort of macro slowdown impacting the core retail segment. So definitely not immune, but at the same time, kind of riding the rising tide of secular tailwinds of offline to online growth will help to offset that to some degree.
Your price target just for the next 12 months is $2,255. That's a lot of room to run in 12 months, too.
Yeah, we believe there's a lot of room to run in 12 months or 24 months, and it really comes down to kind of the same conclusion, which is that if you look at each segment of the business and apply a reasonable multiple, again, we're not asking for significant premiums to what kind of some of the comparative group averages are, you end up at a share price that's significantly higher than where we are today.
Are you the highest price target on the street?
I don't believe our 12-month price target is the highest, but I'm not 100% sure on that.
Okay. Michael, I want to thank you for joining us today. Michael Olsen.
Thank you.